Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a hedge fund manager at Praetorian Capital. He also has Kuppy's event-driven monitor, which tracks a lot of current events and allows for money-making trades. He also blogs at Adventures in Capitalism, and he's been documenting this series called The Fed is Fucked. I think it's appropriate today since we're recording this interview on Tuesday, March 7th, 2023. And we just had the comments. Jerome Powell was testifying before Congress. I want to get his thoughts on that. Harris Kupperman, aka Kuppy, thank you for joining me again.
Hey, thanks for having me on. Appreciate it.
So, Kuppy, Jerome Powell was testifying before Congress today, and he was talking about how interest rates are going to continue going up and there's going to be higher for longer. But you've been blogging about this for over 12 months now in your blog series on Adventures in Capitalism called The Fed is F-U-K-T, fucked. It seems that there's a math problem coming for the Fed. So what do you think interest payments on the debt right now, what we're almost at 900 billion, what do you think they're going to be by the end of the year?
I don't know. It's going to be a bigger number, though. Remember, these things, our government is one of the worst run governments. I mean, they're all pretty poorly run, but ours is especially sort of stupid. And we had over a decade of zero interest rates where we could have termed out all our debt for 30 years, 50 years. I mean, Argentina did it, and they're run by idiots. But they still managed to term out their debt, and we should have termed out our debt. And the fact that we didn't is a just national tragedy. And now, as a result of that, we're going to be rolling forward a lot of T-bills. And I don't have the exact credit stack in front of me. I'm not sure it really matters getting it precisely right or precisely wrong. I mean, I'm a big principles guy, and the big principle is that the interest rates are going to go up on the debt, and as a result, it's going to squeeze out a bunch of other spending types, and it's going to end up being something of a problem. And I don't think it's like a today problem or a tomorrow problem, but it's an eventual problem. And these eventual problems tend to become problems sooner than anyone thinks and expects. At the same time, Powell was kind of chasing his tail around in circles because he printed trillions of dollars, and it's all coming due now. And he's got a mandate to fight inflation. He thinks he's the next Volcker. And I got a feeling he's just going to be chasing the CPI across the screen until he either blows up the Treasury or blows up, Blackstone or, blows up someone. I mean, the history of the Federal Reserve for the past few decades is they printed a bunch of money. Things get bubbly, they raise interest rates, they crash the world, and then they have to print a bunch of money again to bail out their mistake. And I don't see why this one won't go any different, and that the Federal Reserve will keep raising rates until they break something. The difference this time, I think, is that they're going to break something, but the CPI is going to be in the teens, and that's really going to be something of a crisis. I keep saying that this is the decade where developed markets become emerging markets become frontier markets, and frontier markets disappear off the map. Everyone's getting downgraded. And it does seem very much like we're having an emerging markets financial crisis here in slow motion, and the Fed is the last one to know it.
Yeah, in your articles, you're projecting around $1 trillion in interest payments on the national debt sometime in 2023. I mean, if the Fed keeps hiking rates, they have a lot of bonds that they need to reissue. So there's a lot of debt that needs to be rolled over. As you said, they didn't term out, so they didn't issue 50-year or 100-year bonds. They didn't issue long-term debt and lock in a fixed interest payment, and they were borrowing a lot of short-term debt over the last 2.5 years. So there's a math problem coming. It looks like, Kuppy, that the problems are going to be in the private sector first. I know you've studied the Austrian School of Economics. This looks like a classic case of the Austrian school theory of the boom and bust cycle, where we had almost 15 years of zero interest rate policy, artificially cheap currency and credit. That led to an artificial boom. And then when the Fed decides they want to go on to a rate hiking cycle, the private sector then is the one that pays the price, not big government, because government is still borrowing relatively cheaply relative to a lot of these private sector companies. So it looks like a lot of the pain is going to be in the private sector from a lot of these companies, either bankruptcies or mass layoffs.
Yeah, well, I would say that it's a bifurcated market. And this is, I think, where a lot of people are maybe missing what's happening. I mean, you have a bunch of private equity that went out there and levered up a bunch of companies. And I assume that the guys who own the equity are no longer going to own the equity this cycle. I mean, the junior debt, they might not have any equity value either. They might get primed, and it might just be the senior lenders. But these businesses will keep operating, and just there'll be a reshuffling of who owns them. Will jobs get lost? Yeah, of course. But will it be a national tragedy? I don't really know. I mean, quite honestly, the economy is really strong, and you have this weird bifurcated market where it touches interest rates, so housing, commercial real estate, private equity, VC. What was happening in the New York, Los Angeles, Chicago, like those markets that are really tied to the financial markets or tied to tech. Those markets are really suffering. The people involved in those markets are getting layoffs, and they're seeing pain. I can tell you that the rest of the economy is absolutely booming out of control. I mean, we've kind of ignored the flyover for 40 years, but those guys are getting great jobs now. You're seeing manufacturing come back to America. Anyone who knows how to weld or anyone who has pretty much any useful skill whatsoever. In the real world, not the world that works on computers, and there's a bifurcation there. But guys who actually know how to do useful things with their hands. I mean, for the first time in 40 years, they're getting wage increases, and they're getting large wage increases. And I mean, I think this is very good because they've been left behind. But I think it's messing with a lot of the numbers that we're used to, in terms of the finance world. The finance world really just focus on what's happening to the 1%ers or maybe the 10%ers. It never really cares about the rest of the people. And I think it's really missed what's happening here in the other 90% of the population that are really getting wage increases, and they have a ton of disposable income as a result. And look, they have a 30-year mortgage. They have their car on 60 or 72 months. Interest rates don't matter to them. Like, how is the Fed raising 50 bips going to change the fact that their wages just doubled in 3 years? I mean, I always tell the story. A friend of mine runs a restaurant in Miami Beach, and I lived 17 years in Miami Beach, and he was paying $15 an hour for a guy to wash dishes. And now he's paying $45 an hour. I mean, so from 2019 to 2023, so we're talking about 3.5 years, this guy's tripled his salary, $45 an hour. I mean, you're making 80 grand a year, plus you get to eat a pretty damn good lunch and dinner at a 4-star restaurant. Like that's not a bad life at all. And this is for unskilled labor, and he still can't fill the roles. And so, I just think you're seeing this real change because so many people just don't want to do these jobs. Or in the case of, say, aviation or, mechanics or, oil field services, like they just don't have the job skills. They don't know how to do the job. And it takes years to train these people. And I think as a result, you're seeing massive wage growth, and that's very inflationary in terms of how the Federal Reserve tracks CPI. But this wage growth is going into services. These people, last year is the year they went around and bought stuff. This is the year that they're going and just enjoying their life. They're going out to dinner, and they're going to the movies, and they're doing travel, and they're doing all those things they can never afford to do before. And that's why the service economy is so strong. And meanwhile, the Wall Street economy, the economy that we've been tracking our whole professional careers, is going limp, and no one really can explain what's happening. But like I said, it's a two-speed economy. I apologize. I've been rambling a bit, but I really do think the two-speed economy here.
I think there's a lot of great analysis in there. I was actually going to ask you which asset classes or sectors are in the most trouble with these rate hikes. So I think you answered that with commercial real estate and some of the non-service sectors. It seems if wages are going to go up and wages are going to keep increasing, and the service sector is going to keep getting higher wages, this is going to hurt profit margins. You have a lot of these over-indebted large cap companies that did financial engineering and borrowed artificially cheap debt on their balance sheet with share buybacks. Do you expect a lot of dividend cuts in from some of these large caps like Intel? Do you think Intel's just the beginning then of these massive dividend cuts?
Well, I mean, Intel's this interesting story. They did a bunch of financial engineering for a decade, and they bought back a lot of stock. They paid out a lot of dividends, and they didn't invest anything in R&D. And they sort of got left behind in a way. And, they didn't invest in productive capacity. And, we had this whole chip boom. They kind of missed it. And it's kind of surprising when you think about it. But, I mean, the finance guys took over the company and killed it. But I think that's more of a special situation. It's kind of like the IBM situation, as opposed to, what you're going to see in like commercial REITs, where these things literally, they're wrapped in a tax structure that doesn't allow them to retain capital. And so on the way up, you can just borrow against appreciating assets and you can pay dividends or do buybacks or buy other assets. But on the way down, commercial real estate paper, it's 5-year paper and it resets. And these things are starting to reset. And I don't really know how they're going to pay them off because these things were underwritten at 3 caps using 200 bips financing. And now, they're 8 caps and, you got to finance it at 6% or something. And I don't know how it works because the cash flow is not there. And so you go to refinance a building and the lender's telling you have to put up millions and millions, maybe even hundreds of millions of dollars just to get the LTV in line. And then you still don't have the cash flow. And I just don't know how this is all going to work. I think you're going to see a lot of people mailing their keys in. And I think you're going to see a real crisis. And because of the way they financialized everything, and it's some CMBS that owns the asset, it's not even clear really who owns the asset, who's there to service it, and who's there to deal with the default. I mean, these structures weren't really designed for mass defaults. I think it's going to be a really messy, clusterfuckety couple of years. But, your office building will hopefully have the lights still stay on and stay half occupied. And, your hotel building will plod forward, a bunch of dead malls plotted forward. I don't think you're going to see dramatic changes except for who owns the asset. But, I think other sectors like tech, where the VC funding is going to be firmly cut off. I mean, how many dog walking apps do we need? How many electronic scooter bike companies does each city need? I think you're going to see massive waves of layoffs. And remember, you had this kind of unspoken rule in tech where they paid the people somewhat middling wages, but they gave them a ton of stock options. And if the stock was going up, no one really complained because they made a ton of money. And with the stock going down, stocks went down last year, they're probably going to go down again this year in tech. I mean, at some point, these people, if you want to keep good people, you have to give them cash. And it's amazing to look at all these tech companies where they're just barely profitable before stock options. You add back the stock options, and we were talking about a good chunk of the revenue that disappears. Even some of these companies, 50% of revenue is stock options, and they're clearly unprofitable, and it's very clearly an expense if you want to keep these people. And I just don't know how it's going to work, because if you have to actually pay them cash, I mean, like these businesses aren't really viable. I mean, some of them weren't profitable even before the stock options thing. So I just think you're going to see just a lot of these industries detonate. And remember, these industries all do business with each other. All these SaaS businesses are all buying and selling product from each other, and they're buying and selling product with all the other tech companies. I think it's all going to just unwind. I mean, step one was just multiple compression. Step two is that the revenue goes negative. Starts comping negative, and these things weren't really very profitable at the peak. So I think it's going to be just total mess. But we're not in the business really of shorting stuff and guessing what's going to die. I mean, I'm looking for the winners.
So you're looking on the long side, and you've been talking a lot about how you think oil markets are close to bottoming. We've been seeing announcements from either Russia or other OPEC countries. I know there's potentially an OPEC split, but the Saudi oil minister recently said in the last couple of months that they don't have any spare capacity if China comes back online. So do you think the oil markets are close to bottoming?
Yeah, I think we've seen the bottom, quite honestly. I think that, we're going to bounce around the bottom kind of on either side of 75 for a bit longer. And, at some point, I think you're going to see net tightening due to draws. And I think we'll start picking up. I think by the end of the year, we're going to see very large deficits globally in terms of commercial oil, push the price dramatically higher. I don't really know how you fix these deficits outside of a real large recession or something. And even then, I mean, big recessions, oil demand drops 2%. It's not enough to fix the deficit. I mean, the deficit is more like 5 million barrels. And so I think you have a real problem on your hands on the oil side. And it's part of what's going to make this so painful for financial assets is that you're going to have CPI in the teens because oil is going to be triple digits. And Powell is at some point, he's going to chase oil across the screen. And at some point, he's going to have to decide if he wants to catch oil or he wants to save the economy. And I think he decides to save the rest of the economy by printing money and blunting the damage caused by high oil prices. And at that point, Project Zimbabwe begins. And so, we're really attuned to this, but we're mostly just playing it through oil. But I want to find the moment to max out my exposure, and I haven't done that yet.
We're starting to see, though, some production collapses with the decline data from a lot of these shale producing areas. Even the Permian Basin, I was looking at the decline rates for the Delaware Basin. I saw a really interesting chart from one of the companies put out the decline rates on that. So it looks like, I think one of the largest producers said there's only going to be a 500,000 barrel per day production increase out of the US. And it looks like there would need to be tens of billions, if not hundreds of billions of dollars in CapEx investment to fix that inventory problem, that global oil inventory problem that you just described. I don't see a lot of these private sector companies because they're being threatened with windfall profits taxes. If you're in the European Union or United Kingdom and you're like Chevron or ExxonMobil or BP, the governments and bureaucrats and activist ESG investors are threatening to go on your board, and they want you to allocate to wind, solar, and biofuels. They don't want you investing in oil and natural gas. So I don't see any long-term solutions to the supply, this lack of supply that you just described.
Yeah, I don't really see any solutions either, which is what makes this so fascinating. I think, private operators will add capital, but private operators don't have the hundreds of billions of incremental capital that, the world needs. Private operators might have hundreds of millions. They might be able to find investors that can maybe get that number into the billions, but, we need hundreds of billions. And I just don't see where this sort of capital comes from. I don't want to say it's completely hopeless, because I don't think it is. I think high prices will eventually incentivize people to add capital. But I think you need much higher prices than today's price, and I'm not talking about, $5 or $10 higher. I'm talking, multiple, fold increases in the price of oil.
Yeah, and Russia just announced that they're going to be cutting oil production substantially. There could be another Saudi oil cut if oil prices go lower. The other part of this, and you talked about this earlier, was oil services. Schlumberger just announced in the last quarter, a couple of weeks ago, that they're going to be raising prices a lot. So they're going to need to, for drilling and completing wells. So this is not going to mean lower cost oil if the oil service company that's drilling most of the wells in the United States is going to be significantly raising prices.
Right. I mean, remember, they set their budgets in Q4, and they set a dollar value for the budget. And that dollar value buys you a lot less drilling today, even 3 months later, than it did when the budgets were set in December. And I think that if you look at what's happening, and we follow a lot of these energy services companies, I mean, look, inflation isn't just about, tomatoes and broccoli at the grocery store. Every component of drilling a well has gone up in price, and it's going up 20 to 50%, sometimes even 100%. And as a result, that all just gets passed on to the guy drilling wells, or the guy who's paying for a well to be produced. And no, I think you're going to get a lot less bang for your buck in terms of total wells produced per unit of capital you had planned to spend. We have a lot of exposure in the offshore space, and it's just amazing what's happening in offshore, where 18 months ago, pretty modern offshore drill rig was 200,000 a day, give or take 25, 50,000. And now we're talking mid to high 400s. It's basically doubled in price in 18 months. And I think it's going to double again. And, so if it doubles in price, I mean, your price of oil has to double, all else held constant through the rest of the cost structure. And, the price of oil hasn't really doubled. So no, I think you're going to see much higher prices of oil just to justify someone to go out there and take the risk of drilling one of these things. And yeah, I just think the price of oil is going up. And what's really amazing is what's happening on the demand side too. China's reopening. That's 2 to 3 million barrels a day. India's growing, Africa's growing. Everyone's in their S curve. They're just growing fast. The U.S., the SPR is not draining finally. You're looking at what's going to end up being about 5 million barrel deficit, especially with Russia coming off by 500,000 to 1 million barrels, and a bunch of other things that we're tracking. And as a result, I don't know where you find 5 million barrels of supply by the end of this year. And as you drain, the price goes up. It's just physics, or a spreadsheet, I guess. So I mean, in the end, we're just really bullish.
So the WTI West Texas Intermediate crude price is below 80. It's at $77.47 when we're recording this interview. Are profit margins still healthy for a lot of these small cap and medium sized oil and natural gas producers in the US and Canada?
I think it's a loaded question. The way that the accounting works, and I think it's very important to look at this, is that you drill a well, you capitalize that, and then you deplete that well based on what you think you're ultimately going to recover from that well. And there's a lot of flexibility in terms of how you calculate your depletion. There's a lot of flexibility as to what stuff you capitalize versus expense. A lot of guys cheat in all these things. Remember all those wells, back in 2014, when guys were saying they were getting 100 IRRs, but then a year later, everyone went bankrupt, and no one goes bankrupt on 100 IRRs. And I just think that a lot of these guys are still fudging the numbers, and it's really hard for someone like me to go in there and actually call bullshit on this stuff, because the data they give you isn't segmented by well. It's not even segmented by year or tranche. And so as a result, you don't really know. You have how much capital's been spent, and you kind of know how much they produced this year, and you kind of know what the lifting costs are, which is a good starting point on what the cash flow will be if they stop drilling wells. You don't really know a lot of other things like the decline rate. I mean, you have to take them at their word for it. You have to take them at their word for a lot of things, and as a result, it's really hard to say. But I don't think they're making much money here in the mid 70s. If they are, it's only because they drilled a bunch of wells a few years ago when it was much cheaper to do it. In 2019, a lot of the service companies were under massive pressure just to secure EBITDA and hit their covenants. And as a result, they basically operated their equipment at a loss. It's a loss because they show positive EBITDA, but they don't have to calculate the depreciation. And this equipment, it depreciates very rapidly. And so as a result, these services companies ran their businesses at a loss, which is really just a subsidy in the billions and billions of dollars to the guys drilling wells. And that's how they were able to drill cheap wells and for a while keep the price of oil at 50. But that's all over today. And so, there might be some companies that are still reaping the rewards of wells that were drilled very cheaply, but that's not sustainable. And so it's really hard to answer that question. It's kind of a fuzzy math question.
I think you gave a lot of really interesting analysis there, though, talking about how a lot of these companies during the shale bubble, I mean, those IRRs were a joke. I was looking at those investors' presentations many years ago because my day job, I was also an oil stock analyst, and they were claiming their production costs were $10, $20, $30 a barrel, and they were not producing any free cash flow. And any of the companies that did, they were putting it all back into drilling. So they weren't doing anything efficiently at all back then.
They still aren't.
Well, do you expect a lot more mergers and acquisitions than in the US and Canada for the small caps and medium-sized oil and natural gas companies? We're starting to see more deal flow pick up lately.
I think you'll see a lot more deal flow. I think it's actually cheaper to buy oil in the ground right now than to go out there and explore for it. I think a lot of these smaller companies are just horribly mispriced. I also think, and this is a truly fascinating thing about this industry, but I've never met an oil guy who wasn't bullish on oil. And when oil got to 130 this time last year, a bunch of people took on a lot of debt to drill a lot of wells. And with oil at 75, that debt is overbearing in some circumstances, and guys get themselves into trouble. It's the interesting thing about an oil bull market, but guys go bankrupt even in a bull market. They do stuff at the top of the cycle, because there's the 1 year cycle and then the big 5 year cycle, and they don't hedge. They get themselves into trouble. And I genuinely think that you're going to find cheaper stuff buying out guys who are in financial trouble, or even just pubcos that the market's mispricing. Or my favorite is private equity guys, where 5 years ago they invested in some energy thing, and now they have an ESG mandate and they have to sell it, and there's not a lot of buyers for these assets. And it's amazing watching private equity guys sell decent quality energy assets at like PV 30, PV 40, just because they want it off the books, because they're ESG credit. They don't care if SPV number 19 has a 200 bips lower IRR. It's across the whole franchise. They want to be just pushing their ESG thing. So I think you're going to find a lot of stuff to buy in the market and in the private market. I don't see why anyone would drill right now.
And that's the risk with the entire commodities complex, whether it's an oil and natural gas producer, a mining company, a potash or fertilizer company. If commodity prices are high and then the company commits to an enormous amount of production growth, they put the capital in and then they don't lock in a commodities price, and the commodities price falls and they've committed all this capital and then the profit margins aren't there and then the balance sheet's a mess and they're screwed.
Correct. I mean, there's a lot of ways to lose money in resources. It's a very difficult sector.
So recently you disclosed that your hedge fund started building a position into Journey Energy. Do you want to disclose why you think you're bullish on Journey Energy?
Yeah, sure. And, just fair disclosure, we own a couple percent of the company and we're bullish on it. I think Journey Energy is really a different sort of energy company, mainly because of the CEO, Alex Verge. Most of these oil guys just want to drill for buried treasure because that's kind of fun. They don't usually own a lot of stock. Actually, whatever stock they have is usually just gifted to them. And so they're more focused on growing production so they can tell their friends how much production they have, how many wells they have, how many barrels a day. They don't really care what happens to shareholders. And I mean, I think it really shows because most of these smaller energy companies have destroyed capital throughout history. Alex is a bit different. Alex is a value investor who's going out there and buying assets, whether they're distressed assets or distressed just in that someone wants to part with them, maybe not for financial reasons, but for the optics of getting it off their balance sheet. But he's buying semi-distressed assets quite cheaply, focused on Alberta, and he's getting synergies along the way. Low decline oil assets, you don't have to put new capital in. You don't have to care really about drilling costs. You buy the asset, it has a decline curve. You ride that decline curve. There's some things you can do around the edges to fix the decline curve or make it decline less rapidly. But you're basically just buying a stream of oil. You have some decent clarity on what that stream of oil looks like. These tend to be older assets, higher cost assets. You get some operating leverage there just because you have some higher cost. But this is a very amazing way to effectively play an oil bull market. You're taking your cash flow and you're buying more oil assets. You're not paying dividends. You're not buying back. You're definitely not drilling. There'll probably be a little drilling just to keep production in line. You're basically putting in stinker bids on lots of assets and hoping to get hit. And then you're financing it with a combination of debt and, if you can't get enough debt, with equity. But he's done this twice before very successfully. This is his third roll-up. He's put a lot of his own money in. He's a large shareholder. And so far, he's been putting the company together with acquisitions, many of which I think have been really, really smart. I mean, even at the bottom of the cycle, when the company could barely make payroll, he was already taking advantage of guys that were in worse shape than him. And, I think he had a miserable run of it. The company IPO'd in 2014, right at the peak of the cycle, effectively. And it's just been a terrible 6-year run for the company. But along the way, they bought back stock. They did accretive things. They tried their best to create value in an oil price environment that was miserable. And then when things turned, they went on the offensive and they've created a lot of value. And I think now that the wind's hopefully at their back in terms of oil price, they're going to create a whole lot of value, particularly with what they're doing with power gen assets. And that Journey doesn't really get good pricing on their nat gas. It's just the nature of nat gas that's stranded in Canada. And so that they're effectively turning it into electricity with generator assets. This generation business is way more stable than traditional oil and gas, so it deserves a better multiple. But power prices in Alberta are quite high right now, and nat gas pricing is quite low. And I think he's going to, put those two together and create a lot of cash flow. Plus, be able to reduce his own operating costs. But given that, like I said, oil's down from 130 to 75, I have to think guys are kind of wounded. They just did a small little financing. I tend to think Alex is looking for his next deal already. And based on the last deal he did with the Enerplus, I think it's going to create a whole lot of value. If you look at the Enerplus deal, they almost doubled the production of the business by giving away about 10% of the shares outstanding. And these are, very rough numbers, so do your own work on this. But it's pretty amazing to think how creative that was. And the rest was funded with debt and a seller's note. And they've already paid off a good chunk of the seller's note now, too, just with the high oil price. So it's a creative a creative way to structure a deal, and the deal almost double the size of the company. I think he's going to do more things like that. A lot of small little deals and occasionally a really large one. But he's out there just putting stinker bids in on all sorts of stuff, and I think he's going to get hit eventually, especially if the price of oil stays where it is. The longer it stays in the 70s, the more likely it is that someone's wounded, throws in the towel.
And for our listeners who have heard this name before, Journey Energy, oil hedge fund manager Josh Young has also talked about this company extensively. I think he's written a lot of articles on this, on his Seeking Alpha, and then also on his Substack about Journey Energy. Are they one of the cheapest on valuations that you monitor in the oil and natural gas sector?
Yeah, that's what kind of makes this truly interesting. I mean, when you look at valuation, I think PDP is one of the best ways to normalize different assets for gas to liquid content and costs and all sorts of things. You just look at the PDP. I mean, PDP once again is a very abstract number. It's put together by an engineer. It's not the end all at all. It's just a starting point. But the PDP is all done on a similar strip, so it lets you kind of normalize across different companies. And Journey is by far the cheapest. It trades a large discount to its PDP, and an even larger discount to its PDP. And that's a good starting point that you're buying something for way less than it's worth. I mean, the PDP is kind of what it's worth. That's what it's going to produce in the future at a pretty attractive discount rate. I mean, I think it's important to take a step back. A couple of years ago, I got really excited by a company called Sandridge. The stock was trading at $1, and we bought a lot of shares at $1. And at the time, it traded at a massive discount to its PDP, but it also had $2 a share of cash and no debt, and it was cash flow positive. And it didn't take a very smart man to realize that if you could buy something for less than the cash on the balance sheet, and you could buy, and it was profitable, and you could buy it for less than the PDP, as long as they didn't put any more money into the ground, it was going to make a lot of money. And it did make a lot of money. And I sold way too soon, but the stock went way past 20. And I think this is a similar sort of situation where you're buying really, really cheap PDP. And the difference here is that whereas Sandridge just stockpiled cash, Alex intends to use some financial leverage to go out there and acquire other really accretive assets at discounts to PDP as well. And hopefully not use too much equity along the way, but create a whole lot more value, because he's going to be leveraged long financially, operationally, and then just as a value investor from a discount to PDP, putting together all these assets and growing into a bull market in oil, hopefully.
Yeah, a few years from now, cash is probably going to be trash because all these governments and central banks, we were discussing this before we started recording, they all want to inflate. They all want to kind of do their versions of Project Zimbabwe. Even Japan and Japanification is not working. So if you can go and find discounted assets with cash or cheap debt, and you can go buy discounted assets and grow your cash flows and pay off that debt, it's going to work out in the long run.
That's the goal. And, I just think it's truly interesting that you're in this sector, oil and gas, where there's just not a lot of people with capital right now. The traditional players with capital, private equity, they're just not there. I mean, there's some guys active there, but most of them are trying to still divest. They're not trying to put new capital to work, even though you can buy these things based on current strip at 2 and 3 times cash flow, which is kind of crazy when you think about it.
I think a lot of the reason that capital is not going to work in oil and natural gas is everyone's afraid of the politicians, the bureaucrats, the regulators, the Davos crowd on TV threatening windfall profits taxes, ESG mandates, these activist investors coming in and taking board seats on like ExxonMobil and then dictating capital allocation policy saying you cannot invest in a liquefied natural gas project, even though you could get all these long-term contracts for spending billions of dollars and lock in profits. So I think a lot of people are being, even though if the math would work for investing in oil and natural gas, they're being dissuaded by ESG activist investors and bad policies from governments and bureaucrats and regulators. Yes.
I mean, I think it's a funny set of circumstances. I always believe that equity markets are relatively efficient and, there's very few opportunities. And here we are suddenly this weird moment in time where a lot of my competition, they don't actually care if they earn a profit or not. They want to focus on their ESG score. And, I want to just make money for my LPs. And it feels like, I'm playing chess and they're playing backgammon. Like we're playing different games and competing against each other. And there's a reason why I'm doing a lot of winning over the last couple of years.
And you're also seeing a lot of countries, Kuppy, they're still importing liquefied natural gas at sky-high prices. They haven't lifted any of these drilling bans. And then if you Google search, these countries are announcing that they want to build new liquefied natural gas import facilities, but they don't want to allow oil and natural gas drilling in their own country. So they're like, oh, we'll just have someone else do the drilling and we'll just import it at market prices. No big deal.
Right. I mean, I think, the U.S. has been exporting its pollution to third world countries for half a century, and everyone else is kind of doing the same. And, eventually you run out of third world countries that have the resources or that want your polluting industries. I think we've hit that moment in time now. And as a result, you have to bring those industries back to the U.S. But if you want to do it in a way that is more environmentally friendly, your costs explode. And I think that's what we're kind of seeing right now. And, it's all inflationary. Like every single thing is inflationary. And I don't know who these people are that think we're going to have deflation or that inflation rates will stagnate. I think, the 70s are a really good template where there were periods where inflation accelerated. Then there were periods where inflation slowed. I mean, smart business people find ways to switch to save costs, to solve problems, and then inflation accelerates again. And I think we're in the end of the inflation slowing phase. It kind of peaked out last year, and I think Q1, maybe Q2, inflation continues to moderate, and then we see it accelerate again. I mean, just think about it. Oil was 130 this time last year, and now it's 75. I mean, just think what that's done to ease the inflation burden. And, play it forward 6 months or so when oil is triple digits and it's comping against $80 oil. Of course, inflation is going to accelerate. I mean, wages are going to stay high. And yeah, the trinkets you buy at Walmart, your goods, I mean, maybe those will be down in price and that'll offset a bit. And maybe rents will do what rents do. But I think you're going to see a lot of inflation. And then, some other part of the economy will get squeezed on pricing and that'll inflate. And, this cycle will just keep going on and on.
Well, if we had oil and natural gas drilling a lot in many different countries, those drilling bans were lifted. These countries were actually allowing cheaper electricity options with nuclear power. Maybe these things would alleviate. There would be less inflation, but the policies seem to be doing the exact opposite.
Yeah, correct. I mean, there's always this view that inflation is a monetary phenomenon, and that I don't disagree with that, but I think it's a monetary phenomenon divided by the quantity of goods that can be produced. And when regulators get in the way of the production of goods, then you have inflation. If regulators let business people respond and produce additional goods, then that amount of money that's been produced on the monetary side, it'll get absorbed. There'll be a lag, but it'll get absorbed eventually. What's happening right now is that the governments are effectively getting in the way of the production of new goods. And that's why we're having inflation. And the governments will find ways to ease up on something and then some other thing will break. And that's just the nature of governments being overly involved in the economic cycle.
Well, they're also trying to force energy prices higher with a lot of their policies. So they want less energy supply of conventional fuels like oil, natural gas, coal, and nuclear power is kind of the third rail for a lot of these countries. I know you cover uranium and nuclear power because we've had a lot of discussions about this over the last 12 to 18 months on our other interviews. Do you see a lot of other countries restarting their nuclear power plants soon?
Japan is, Korea is, France is. I think all countries eventually will, just because, humans are kind of funny and irrational, but irrational kind of in the same way. They're going to try every possible thing, and then they're going to go to the thing that actually works. And if you want baseload power that's affordable, nuclear is probably your best option. I mean, most countries just don't have enough rivers to dam. And the net result is I think you're going to see a real renaissance in nuclear. But it's going to take a lot of time, and it's going to take a lot of governments trying to do the wrong thing first. But we're increasingly seeing the countries that were at the forefront of anti-nuclear changing their tack, just because in a democracy, you can't have the peasants pay 50 cents a kilowatt. And so I just think it's inevitable. And I like getting in front of investments that are almost inevitable. Nuclear will have to be a larger component of total electrical consumption at some point, 10 years in the future. It takes a long time to build these plants. But the first step is to stop shutting them off. And I think we've seen a lot of that. The second step is to reactivate the ones that are shut off. We're seeing a bunch of that right now.
Yeah, you're seeing a lot of manufacturers leave Germany because they don't have the relative advantage of cheaper electricity anymore. So BASF, they don't have all that cheap natural gas for fertilizer companies or chemicals or plastics. And then they don't have cheap electricity available for nuclear power or cheaper natural gas because they've had to import a lot of either coal or liquefied natural gas over this winter. I think Germany spent over $500 billion in a very short amount of time. I mean, that type of spending just for energy imports is really not sustainable for their manufacturing base or for their consumers.
Right. But I mean, the dirty secret is Germany's now burning coal.
Yeah. Well, while their politicians go to Davos, yeah.
Yeah, I mean, I think that's really the dirty secret here. Germany has gone completely about face, and now they're basically just burning coal because none of the other stuff they tried works. I mean, I think everyone's kind of known. Well, I've known that green energy was a total charade. It wasn't going to work, and I think one by one, people are waking up to the fact that it doesn't work. And the only way to whitewash that is to have something that's baseload energy. And after vilifying coal for 20 years, they have to go to nuclear. It's the only other option they have.
Over the next 12 to 18 months, you see the consumer price index, you see that start to head higher, largely because of what? Higher energy prices. Do you see consumer spending start to go down then if energy prices would continue to go up?
Well, I think energy prices go up. I think wages go up, and that all gets imputed into the price of everything. I mean, those are two of the largest components of every good that I consume in my life, whether it's services or, just finished goods. So I think we're going to see a lot of inflation. I think the Federal Reserve will raise interest rates to try to chase that inflation. Financing costs is another expensive input. I mean, I've been of the view for a very long period of time that 0% interest rates are deflationary and higher interest rates are inflationary. I know that's counter to what a lot of economists would tell you, but everything in front of my eyes says that when you raise interest rates, you raise the cost of goods because financing cost in a very financialized economy is one of the inputs that goes into goods. So no, I think we're going to see a lot of inflation. What's interesting though is that I don't know if it stops people from buying stuff. I think there's a very good chance that at the fiscal level, the government keeps running massive deficits. They keep giving stimulus to people, and people have plenty of these depreciating paper dollars to go buy stuff. I also think people are getting massive wage increases. I mean, let's say inflation is teens in 2024. I mean, what do you think wages are going to do? I think wages are going to be way faster than teens for the 90% of people that aren't in VC tech and finance. And I think the economy is going to do reasonably well. One of the things I think people will make a mistake in Wall Street is that they look at the real economy. And that's fine. I mean, we're in Wall Street. We all get judged in the real economy, but the vast majority of consumers are still in the nominal economy. And in the nominal economy, things are doing really, really well right now. And everyone has cash in their pockets. And yeah, there's inflation, but people complain about inflation, but they have cash in their pockets. And I think people, need to look at what's happening in the nominal economy because we haven't had inflation rates like we're having in a very long period of time. And we forgot that the nominal economy is very different from the real economy. And like I said, the nominal economy is doing great.
So over the last 12 to 18 months, we've seen an enormous increase in central bank gold buying. We just had Singapore announce 44 tons of metric gold. China, the People's Bank of China, their central bank, just bought, I think for the fourth consecutive month, they publicly disclosed that they bought even more physical gold. Why do you think these central banks, if they're running trade surpluses, why are they buying physical gold in tonnage when they can go and buy U.S. treasuries and they're getting 5 or 6%? It doesn't seem to make a lot of sense unless they want to they don't trust that the U.S. federal government is going to be able to continue to pay out higher interest rates and is going to have to cut rates.
I mean, why do you want U.S. treasuries that pay you 5% when inflation is already at 6 or something, the official number, and it's going higher? I mean, why do you want something that is the liability of crazy politicians? Russia just learned that those treasuries could go away. If you do the wrong thing, if you talk to the wrong people, you have the wrong friends politically. across the globe. No, I don't want, treasuries. I don't want gold. I want that in my own vault in my own country. I think, they blew up the dollar when they cut Russia out of the SWIFT. I mean, that was the final straw for the dollar. And, I think it'll still be the reserve currency for a very long period of time because there's no other viable option, quite honestly. But, I think the desirability of dollars to just stockpile them indefinitely has gone down. Now dollars are a medium exchange. It's a liquid, currency to be used to facilitate transactions. But as soon as you get a dollar in your hand, you want to turn that into something that's real. You definitely don't want to be sitting with these dollars.
That's funny because I don't know if you just saw the data that's come out in the last week or so, but the retail investor here in the United States is on a record buying spree for U.S. Treasuries. I mean, it's the graph has just gone parabolic.
And with very few exceptions in my investing career, the retail investor is always making the wrong decision.
Yeah, well, there's a lot of retail investors right now are very anti-gold, very anti-commodities, very anti-energy. Hardly anyone was looking at buying natural gas companies after that crash. I was having people tell me that natural gas was going to stay below 2 here in the United States, armchair quarterbacks, without looking at any of the production costs from the producers. I mean, there would have been a lot of bankruptcies if natural gas stayed below 2 for a long period of time.
Yeah, I remember people telling me that too. Meanwhile, I was buying Antero Resources below $1. A lot of it. No, I mean, when people tell you something, they all agree. It's usually a good time to do the opposite. And I don't have a great view on what T-bill rates are going to do, but they're paying you 5% for a reason because it's kind of a sucker's bet. I mean, you should be buying hard assets.
Well, and at some point, the Fed's probably going to have to cut because then it gets into what you've been blogging about on Adventures in Capitalism for the last 12 months. The Fed's not going to be able to pay way over $1 trillion per year in interest payments on the national debt. It's just going to take up way too much of the annual tax receipts.
Well, they're just going to print the money, but I don't think they realize that yet. They will. I think the other thing they may do, and I think this might surprise people, is they may force the commercial banks to buy more of these treasuries. And they may just stuff the commercial banks. We've seen a lot of countries like Argentina do that, where they blow up their own banking system while trying to, prop up the fiscal deficits. And that way, you don't have to have the central bank print the money. You just basically force the banks. You change some accounting rules, and you just ignore the mark to market indefinitely. But you force basically the banks to buy these assets. I think that's probably the direction we're going to go, as opposed to just having the central bank print a trillion or whatever the number ends up being. I mean, the deficits are just too big.
So it's similar to what Japan did, the Bank of Japan, after their bust and turning their banks into zombie banks with accounting fraud and stuffing the banks with their government debt.
Yeah, I mean, most countries try the same failed adventures over and over because politicians have 2-year election cycles in this country, and cause and effect often runs on a different timetable. I mean, that's why I've been so successful. My timeline is different from politicians, so I could sit there and wait. And lots of things are obvious, especially if they've tried it a few times.
Well, last question before I let you go. Are you more bullish than over the next 2 or 3 years then on oil and natural gas prices? So energy, oil, natural gas, and uranium than you are on gold or silver?
Oh, much more bullish on energy than gold and silver. I mean, look, gold, it's nice to have, but there's no reason you need it. All the gold that's ever been produced is sitting in a warehouse somewhere. It's in a vault. It's in someone's stock drawer. Like, I don't see why you need that. I mean, gold, the reason people buy gold is that over long periods of time, it roughly tracks inflation, and it leads and it lags, but over a long period of time, it tracks inflation. So it's a great constant. It has minimal storage costs. And there's a bunch of other, things about divisibility and whatnot that make it useful. But, I'd much rather own a commodity that's in deficit, where the consumption is more than the production. There's not a lot of it above ground in terms of days of usage. And people really need to go about their day. I mean, if I didn't have gold coins, like, I wouldn't notice. If I didn't have oil in my truck, I mean, I'd be pretty annoyed. And it's amazing to think that I could take my truck, 20 miles for $4. It's just amazing to think how cheap that is still. in terms of like true utility. And, I'm definitely not going to walk 20 miles. And so, no, I think I'd much rather own something that is closer to the cost of production than gold. Gold's decently above the cost of production right now, and I'd much rather own something that has real need and utility. In terms of silver, that's just flare gas. I mean, buying silver any price above 20. I mean, that's literally like saying I'm bullish nat gas in like 2010 or 2015, knowing that the Permian's about to bury you in that gas. I mean, I think the world's gonna be buried in silver. I think that's the obvious short to everything else you do with inflation.
Those are some interesting takes. I mean, for energy, though, as we discussed over a lot of interview, there's just active policies from many governments, many bureaucrats, many Davos crowd billionaires who are on these crusades, activist investors that are actively against more oil supply, more natural gas supply, liquefied natural gas projects, nuclear power. So the people, they're trying to prevent supply from coming online. And we're either going to have supply problems or higher prices or both.
Right. And, just going full circle here, we talked about Journey Energy. The real risk of Journey Energy, in my mind, isn't, the actual investment merits. It's that Trudeau does something insane. He's shown himself to effectively be a little African dictator, and little African dictators wake up in the morning doing crazy things. And I think that's really the risk of an investment there, is what's going to come out from a policy standpoint. And it's a reason that I don't own any other producers. I own the service companies because in the end, the solution to the coming energy crisis is that hundreds of billions of dollars incrementally every year for many years will need to be spent on oil exploration. And if a country like Canada gets in the way, some other country will gain market share in oil. And all I need to know is that my equipment's going to get used. It's going to get used at very high profitability rates. And so that's why I'm so bullish on the equipment itself. And then the rest of my bet is physical oil. I own a ton of futures call options and call spreads.
So if my listeners want to check out Kuppy's event-driven monitor, how do they do so?
So if you want to learn more about our event-driven monitor, go to kedm.com and take a free trial, kedm.com. I'm sure you can link in the show notes. We're monitoring over 20 events, corporate events mainly. We found these events to set off some sort of change in direction of a company. We're inflection investors, and a lot of inflections are not just driven by the macro. It's driven by CEO change, demutualization, privatization, cap structure change. Sometimes you're going to see cluster insider buys or buybacks or spin-off. All these things will set a direction of a company in a different direction. And Wall Street's really good at tracking linear things. Wall Street has just a terrible track record of things that are inflecting and trying to value those assets. And we think that Kedem is going to flag, and it has flagged a lot of mispriced securities. Our job is to tell you, hey, this thing is happening, and then your job is to dig into the weeds and figure out if it's interesting to you. But over time, we've built out the product mainly because we needed the data ourselves. So, it's a product built by a hedge fund for hedge funds.
And Wall Street doesn't have a lot of people compared to a lot of these other industries like tech and even crypto covering commodities related companies. I mean, over the last 3, 4, 5 decades, they've cut the budgets for the research and the analysts that they have on staff immensely.
Yes, they have. Wherever they're firing research analysts is usually where you want to look. And the places they're doing a lot of IPOs, that's where you want to stay away from.
And those were all those fake tech companies that were all service companies with an app, basically a middleman then.
Correct. Yeah. But I mean, a lot of these things, they just had no reason to exist, and a lot of them won't exist in a few more years.
Yeah, especially those home flippers. I mean, those home flippers were growing. They were losing money at scale. So they were borrowing at cheap interest rates, right, to do home flipping. And then the more they borrowed at cheaper interest rates, the more money they lost. It was kind of comical what they were trying to do.
Yeah. I mean, SoftBank business model never made sense. And I think we're going to look back on this and all laugh pretty hard.
We're both friends with Chris McIntosh. I mean, he's saying that they're going to get away with kind of Enron style or Lehman Brothers, some of these large companies doing mark-to-model accounting fraud. So we'll see what the Japanese government allows them to. But yeah, if you just look at the numbers, I mean, yeah, they're going to have a bankruptcy problem unless they're allowed to get away with accounting rules changes.
I think you're going to see this across a lot of private equity, VC. I mean, a lot of pension funds that invest in these entities, they've already lost all their money. The funny thing is that the pension fund doesn't realize it yet. And, there's another 7 years until you have a liquidation event and the pension fund realizes all the money's gone. Right now, the pension funds are still putting more money in because they think they're actually up.
Oh, it's a total mess. There's tons of accounting fraud there. I've heard a pension fund consultant that gets hired to go in and look at the books of these pension funds, talk about the accounting fraud. The whole thing is a mess in there.
Yep, that's what happens in an economic cycle. And at the other end of the cycle, a bunch of really cheap stocks get tarnished and we get to buy them really cheaply. And right now we're at the part of the cycle where you just got to focus on not doing anything too stupid and make it to the other side, because all the opportunity is at the other side. It's not today.